Go. All right, good afternoon, everyone. Thank you for joining us. My name is Ron Quaranta, Chairman of the Wall Street Blockchain Alliance. It is 2 p.m. Eastern Time here in New York City. Thank you for joining this month's WSBA special webinar with our colleagues and friends from Lukka and Sovos, presenting on the very timely topic of tax information reporting for cryptocurrency transactions. With that, I will turn over to my colleagues to begin.
Well, good afternoon. My name is Wendy Walker. I have been working in and around tax withholding and information reporting for a little more than 15 years now. I am a former client of Sovos. I have led tax compliance and tax operations teams in large global financial institutions, and my teams used Sovos' products and services in those roles. At Sovos, I'm a solution principal on our go-to-market team, where I analyze how new or changed IRS and state tax requirements impact our products and services. I also investigate how new industries are impacted by withholding and tax reporting requirements. And I also seek out ways to grow our business either through M&A or through strategic partnerships.
Thank you, Wendy. Hello, everyone. Thank you for joining. My name is Jeremy Drain. I'm the Chief Commercial Officer here at Lukka. I've been here for 3 years. In my role, I'm responsible for sales, marketing, account management, customer success. Prior to working here at Lukka, I worked for 13 years at PricewaterhouseCoopers, where in my last role, I helped found PwC US's blockchain and crypto practice. So looking forward to today's presentation.
So to kick us off today, we're going to jump over to our agenda here. Just a quick disclaimer before we do that. This is just basically saying that we're not giving you any tax advice. Certainly, we can answer questions and try to help you as best as possible, but just note that you should be seeking a tax professional for that advice. All right, so for the agenda today, we're going to kick off with a bit of an overview of just sort of what's happening within the industry. Certainly talking about guidance that's been shaping, whether that's from the IRS or others. And then we'll get into some of the common taxable transactions that we see in the virtual currency space. And then we'll wrap it up and talk about tax information reporting best practices. Okay. So first I'm going to just start off a little background about who Sovos is. So we are the largest private filer of Forms 1099 to the IRS. We filed over 700 million records for 2018 on behalf of our clients. That makes up about 20% of all of the forms that the IRS receives. We've been providing tax withholding and reporting solutions for over 30 years in this space. And in the last 5 years, we've grown largely through merger and acquisition. We offer a variety of tax technology products and services for tax regimes in over 100 tax jurisdictions around the world. We have a presence in 9 countries. Tax compliance, as you can imagine, it's different in every state in the United States and in every country around the world. So at Sovos, we try to offer solutions, for example, here in the US for sales and use tax, insurance premium tax and statutory reporting, unclaimed property, and of course, what we're talking about today, tax withholding and reporting related to Forms 1099 and 1042S and FATCA compliance. Outside the United States, we have solutions for value-added tax or VAT, solutions for e-invoicing, which is a Latin American compliance regime, and then the Common Reporting Standard, or CRS, which is a reporting regime that's been adopted by more than 100 countries. So as you can see, Sovos is on a mission to solve tax for good for our clients, no matter where they might be operating in the world.
Thank you, Wendy. Lukka, we are one of the world's largest crypto accounting, tax, and audit software firms. Our customer segments include funds, fund administrators, exchanges, OTC desks, accounting firms, and miners and lenders. Our mission is very straightforward. What we try to do is transform crypto data into auditable information and then so that organizations can improve operations, create financial statements such as P&Ls, and provide regulatory reporting. We're a New York-based software firm, approximately 50 employees, and to date have raised approximately $25 million in VC.
So everyone who is involved with virtual currency transactions has some sort of, perspective in terms of the difficulties they're facing as a result of this new and emerging market. And tax reporting is no different. In this section, we're going to talk about the high-level tax information reporting impacts to the virtual currency industry. So, to date, we've had very limited and now very outdated guidance from the IRS. It dates back to 2014, and we'll talk more about it later. But there's gaps in the securities and commodities and related tax laws that impact payers and individuals in terms of how to calculate gains and losses, and in terms of who's required to actually report information to the IRS. Crypto entrepreneurs are generally not experienced with tax reporting obligations, so it's often not understood that an obligation actually exists, and certainly how to solve for them. The IRS has estimated that there is about $25 billion a year of underreported crypto income. So at least as of 2016, before the crypto winter, that was the case. And when income goes unreported to the IRS on a 1099 or a W-2 form, the IRS cites that less than 20% of taxpayers will pay the income taxes associated with that income. So despite the non-compliance, the IRS really has chosen to enforce rather than educate the community really up to this point. So in 2016, for example, they served a John Doe summons on Coinbase requesting all of their taxpayer information and transactions for prior years. Coinbase ultimately agreed to turn over a portion of those records, and this kind of set the stage for some of the reporting that we're seeing in the industry today. Since the IRS guidance is very sparse, we've seen some exchanges report the 1099-K, like Coinbase, and some of them have reported the 1099-B, like ItBit, for example. But what these appear to be the same transactions that are being reported on these two different forms. The 1099-B requires every transaction of an asset traded or sold. So a single individual could be required to receive thousands of 1099-B forms depending on how much trading or selling that they're doing during the year. The 1099-K form, alternatively, it's supposed to be used for goods and services payments, for reporting goods and services occurring over payment networks like PayPal transactions or Venmo. So if crypto is being used to pay for goods or services, then I would expect to see a Form 1099-K issue. The 1099-K has a different reporting thresholds than the 1099-B. It affords payers to apply a $20,000 and 200 transaction limit before reporting is actually required. So it minimizes the reporting impact of cryptocurrency trading and payment transactions, on the payer. Also, these 1099 forms actually have different tax implications for the taxpayer. Although they're both reporting what we call gross proceeds amounts, the methods by which deductions can be taken on the Form 1040 or other forms is a different path when you receive a 1099-K versus a 1099-B. And so really the reporting clarity is needed in order to really ensure that the market is set up for compliance now, rather than after the market has implemented processes and technology for some other form and created long-term, potentially long-term liability issues for their taxpayer, their individual clients. So for today's purpose, I'm not going to get into the specifics of the 1099-K because the IRS comments to the Congress last month have signaled that cost basis reporting is imminent, and we generally see cost basis information reported on Form 1099-B. So later on, I'll talk about the challenges and best practices with that form. So as with any new emerging market, regulation has been very slow to adapt. We've seen this with the SEC, we've seen this with the CFTC, FINRA, and so forth, and it's no different with the IRS. So in this section, we're going to talk about some IRS guidance, changes to the tax law, and then just industry feedback that's influencing the IRS position on virtual currency transactions. So really the only guidance that we have related to virtual currency is this Notice 2014-21, which was issued in 2014. And this notice is actually, it's styled like an FAQ document, but it does clarify a few important things. First is that it clarifies that the IRS views cryptocurrency as property for federal tax purposes. That's important because taxes on property trades or property sales are generally defined by basis. Right? The value of the asset when it was purchased minus the value of the asset when it was sold. And so that's generally reported on a Form 1099-B by the payer. Second thing is that, it really clarified that when cryptocurrency is used to pay for goods or services, it's taxable income to the recipient. And that's important for a payer of that because payments of taxable income for goods and services are already required to be reported on Form 1099-MIS or 1099-K, depending on the payment circumstances. And then the third thing I would say is that it confirmed that when cryptocurrency is paid to individuals in exchange for their personal service, such as wages or non-employee compensation, that it's taxable income to the recipient, which also follows the bullet point further down in this slide about mining services. So again, this income is reportable by a payer either on a W-2 or a 1099 miscellaneous or a 1099-K, depending on the details. Gains or losses that are associated with investing and trading cryptocurrency is taxable to the recipient. And the information to calculate that is generally reportable on the 1099-B by the payer. All of these forms that I've mentioned, they require some form of income tax withholding in addition to tax information reporting. And this isn't a simple process for a payer of this income. There's a variety of calculations and details that goes into producing these forms. And this FAQ style notice that we have from the IRS left many unanswered questions. So since this Notice 2014-21, it defined crypto as property, many taxpayers and payers of income assumed that like-kind exchanges, the like-kind exchange tax law under Section 1031, or it's sometimes called the 1031 exchange rule. This is, for example, where you might buy one coin and trade it for another. So you defer any gains until a future date. Well, in 2018, the government, through the Tax Cuts and Jobs Act, redefined that term property under Section 1031 and redefined it as what's now known as real property. And real property is something that the IRS defined years ago as land and anything built on it. So generally, they were real estate related property sales. This firmly eliminated crypto trades from this tax reporting exemption and certainly from deferring the gain down the road. If you're not familiar, the Information Reporting Program Advisory Committee, or it's formerly known as IRPAC, this is a group that for years and years and years has provided advice to the IRS on behalf of industry that it represents related to complex withholding and tax information reporting issues. That group has now been merged into a new group called IRSAC, but last year 2018 was the last year, and in their final report, they really expressed their frustration with the lack of guidance and expressed some really detailed, complex questions to consider given these transactions impact not only 1099 reporting, but also the Foreign Account Tax Compliance Act, or FATCA. And large banks and financial institutions, they want to invest in this market, but these tax requirements are significant, and they want some clarity before they can really invest in this market. Another thing to talk about here is that some members of the Congress have a vested interest in the success of virtual currency. They have a vested interest in the success of blockchain technology, and they're vocal about pushing for common sense regulation. As it relates to tax guidance, more than 20 congressional members from both sides of the aisle have written a total of 4 separate letters to the IRS urging them to provide guidance. These letters started being sent back, I think, in 2017. And up until recently, the IRS had not responded. The last letter that Congress sent, it was a little nasty the way that it was worded. Taxpayers had just gone through yet another season without any guidance, and certainly the tax practitioner community was up in arms as they were not clear how they could help their clients. The last letter that Congress sent in the end of April 2019 demanded a response from the IRS, and in fact gave a deadline of May 15th, 2019. And the IRS Commissioner Rettig, he did finally respond. So on May 16th, the commissioner, he actually wrote back to Tom Emmer, who's a representative from Minnesota, and he advised that the IRS would provide guidance soon, and he alluded to some very specific details that would be addressed in that guidance, including cost basis calculation details, acceptable valuation methods, and the tax treatment of forked transactions. On May 30th, the commissioner spoke again at an insurance conference, and he again, when asked questions about the guidance, he committed to the guidance coming, this time stating it would come within the next 30 days, possibly sooner. He also hinted at additional details that the guidance would include, this time focused on transactions that some taxpayers may have previously determined were not taxable or that they thought might have been exempt from the requirements. The other thing is that the commissioner has stated that the guidance will come in the form of revenue procedures or revenue rulings. This is very important to note because what that means is that they don't think that there is a tax law change that's needed in order to make people start to report the cost basis requirements or some of the other things that I talked about today. We usually see, it also means, by the way, that there is likely not going to be a safe harbor for prior years of non-compliance. We usually see those longer implementation of requirements and those safe harbors when there's a new law or when there's a change in the tax law, and they usually communicate that via notices. But a revenue procedure provides return filing or other instructions concerning the IRS's position on a specific topic. For example, it might specify how those entitled to deduct crypto trading expenses, should compute those deductions. And a revenue ruling is an official interpretation by the IRS of the Internal Revenue Code related statutes, tax treaties, and regs. And it's the conclusion of the IRS on how the law is applied to a specific set of facts. So you can see that that's different than a notice where they might be asking the community for feedback, and then where they might take that feedback and shape the tax law changes. So definitely sounds as if it's going to be just a clarification of guidance. Okay, so as we think about how this forthcoming guidance from the IRS will impact the industry, we really want to start with looking at the transactions that give rise to tax withholding and information reporting in the crypto space. And so this slide, it's just some examples, by the way, of where a transaction could be taxable or tax reportable on a Form 1099 or other form. This means that not only could the individual be required to treat the income as taxable, but that the payer could be required to report that information on some sort of form, both to the IRS and to the state tax authorities. Note that there are instances where a transaction may not be taxable or an exclusion applies for the taxpayer in the tax law. That doesn't mean the payer is not required to report. And that's where a lot of people misinterpret the tax reporting requirements. So remember, just because there might be an exemption that exists for the taxpayer who received the income, that doesn't mean that the transaction is not reportable by the payer. So first thing there is receiving payments in crypto in exchange for goods or services or as a salary is treated as wage-related income. And the value that would be reported on a W-2 or a 1099 miscellaneous or a 1099-K would be the value of the asset at the time of receipt of the payment. So for example, miners should receive a MISC or a K or a W-2 in exchange for their services performed to mine the asset, and then the value would be the value of the asset at the time that the crypto is deposited in their wallet. This is clearly discussed in that IRS 2014-21 notice. Spending crypto to buy products or services triggers a gain or loss event for the holder. So the date they disposed of it is used to calculate their cost basis. In these transactions, if a third party is acting as an intermediary to the buyer and the seller, there's likely a 1099-K obligation to report the transaction received by the recipient of the crypto. Exchanging one token for another can generate gains or losses. Cost basis is generally calculated using the value of the asset on the date it was purchased and then the value as of the date that it was sold. Intermediaries that settle these types of transactions will likely have an obligation to report the 1099-B soon, given the comments by the commissioner that I just covered previously. Converting crypto to US dollars or another type of currency where a gain is realized could be reportable on a 1099 INT or a 1099-B, depending on how, again, that transaction is structured. Airdrops, these are basically income gifts. So the basis of the asset at the time of the airdrop is recorded, and then when the asset is sold or traded later, the value at the time of sale is the second part of the calculation needed for cost basis. I've heard about 401k and other kind of retirement products coming out where they're offering investments in crypto assets. When amounts from retirement accounts are distributed, it's reportable on a Form 1099-R, and there is significant federal and state income tax obligations, withholding and reporting associated with that form. Going on to initial coin offerings. So these don't follow the IRS's tax-free treatment for raising capital. So the income that they produce is reportable. It could be a 1099 div or a B, again, depending on how that transaction is structured. Here recently, I've seen some companies offering to pay interest on crypto deposits, and that's reportable on the Form 1099 INT. And then let's not forget to mention at the end of the slide here that whenever a transaction is reportable on a 1099 to the IRS, it is also reportable to the recipient's state of tax residence as well. It isn't based on where your company has nexus, it's based on where the recipient resides according to your books and records, the address that you have on file. And so if you have a recipient in Ohio, then you must report following Ohio rules, for example. And this is important because a lot of people will implement the IRS requirements and not the state requirements. And then just the other thing I would add to that here at the end is that sometimes the IRS will have thresholds that are much higher for reporting, like that 1099K that we talked about, but the states have set their own thresholds for reporting. For example, in Vermont and Massachusetts, that 1099K is required to be reported at a $600 level. So sometimes you'll have data that's required to be reported to a state that wasn't necessarily required to be reported to the IRS. All right. So in that last section, we talked about a lot of different 1099 forms at a high level. And as I mentioned, we really wanted to focus on the more complex Form 1099-B in this segment of the presentation. Given the IRS guidance is definitely going to include cost basis details, we thought that it would be pertinent to give you an insight into the challenges and the best practices that are related to reporting of that data, in order to help payers and intermediaries really, prepare for the coming regulations. So to start this off, we wanted to show kind of what a high-level picture of this technical process looks like in a typical exchange client or a U.S. payer of these types of transactions. So on the left side, we'll start the source tax identification information like names and addresses and taxpayer identification numbers, and then any withholding data. All of that would come from the exchange or the payer's source system. The transactional data that's needed for the 1099-B, including like dates and amounts, those things will come from the blockchain, and then the subsequent calculations need to occur in order to determine that reportable income that has to be transformed into a 1099-B at the end of this process. Once the data is ready for reporting, outputs have to be created. There's a version for the IRS and a version for the end recipient, and then there's one for each and every state for which you need to report to. And each state has a different format. The IRS's formats are different, and the recipient versions are different. They change every year, and there are intricate rules associated with them that involve some tax interpretations as well as the threat of IRS penalty for failure to get it right. So in our examples today, we're going to highlight some of the challenges and the best practices associated with these 1099-B reporting processes.
All right, so I'm up.
Sorry, you can go back one. Yeah,
Go back one.
there you go.
Okay, So up to this point in time, Wendy has been talking a lot about the IRS guidance, is talking about types of different transactions. And from that perspective, the next sets of slides, we're going to be talking about more around the data impact, because really what we're talking about is a data problem in terms of extracting information from a client, preparing that information for processing, and then passing it to Sovos so that they can create the various forms that the taxpayer requires. So with that, what we'll do is the first thing I'd like to do is give you a sense as to the platform itself in terms of what Lukka provides and sort of the role that we play in the process. So in this slide, it's on the left-hand side, these are the data inputs. And the middle section is the infrastructure that Lukka provides. We call it a crypto asset data platform. And then on the right-hand side, it's the producing of the outputs. I'll actually come back to this slide once I add a little context further on in this presentation. Okay, so the very first thing that taxpayers are going to have to deal with in terms of gathering the information is establishing connectivity to the data sources. And what taxpayers typically find is that their transactional data is scattered across multiple unstandardized sources globally. And these take the form in terms of exchanges, OTC desks. There's 2,000 blockchains and many, many different types of wallets. Their transactional data is scattered across mining pools within smart contracts. And then they have to pull data from different banks and enterprise systems. And so the very first issue that you're going to have to deal with here is you're going to have to find a way to programmatically extract your data from all of the data venues that that's holding your transactional data. And we find this to be something that without a programmatic tool, it's impossible to do it via CSV files and so forth. So this is the very first challenge that taxpayers are going to have to deal with. The second issue is that once you have pulled in all of that data, you're going to see that none of the data is actually standardized. And what you'll see is you're going to have inconsistent names, you're going to have inconsistent tickers, your pairs are going to aren't going to have any unique identifiers, and it's going to be incredibly difficult for you to take all of this transactional data that's scattered from all of these different sources, pull it into a central source, and be able to make any sense of it. And so one of the things we did here on this slide is provide you an example of just how challenging this can be for taxpayers. So we picked a pretty standard digital asset called Stellar. And what we're trying to show here is that first, that this digital asset has multiple ticker symbols. There's no QSIP in this ecosystem. Exchanges can call Stellar whatever they want to. And in this case, you can see that Bittrex is calling Stellar XLM, Bitfinex is calling it STR, Kraken calls it XSTR. And so, as you can imagine, if you're pulling in data from lots of different data sources and what you end up are files that have all of these different ticker symbols, how are you going to know what it actually means? And the other aspect to this is a lot of people trade one capital asset against another. So they'll trade, say, Bitcoin for Ether or Ether for Stellar. And when you start to get into those types of transactions, you'll see that there's a lot of pair inconsistencies. And so what we did here again in the right-hand side of the slide is we showed showing Bitcoin versus XLM. Well, we showed a bunch of different digital assets, but what we tried to show is just how different they are in terms of form and format. You'll see that there's dashes, they're capitalized, they're lowercase, they're slashes. And so what the issue here that the taxpayer is going to have to deal with is how are you going to programmatically apply standard reference data to all of your extracted your crypto data. And at the end of the day, if you can imagine, as you pull in all of that information, unless you have a programmatic approach for standardizing that reference data, you're going to spend an awful lot of time, manual hours, working your way through this. And this is something that, as we'll talk about in a little bit, something that Lukka has solved for, but something that certainly taxpayers are going to have to take into account in order to move their data through the processing. Okay, so next thing is data reconciliation. So what we talked about was we have connectivity, so we've grabbed all of the transactional data from lots of different data sources. All of that data now sits in a subledger, and now we have to standardize it with reference data. And now the taxpayer has to ask a very specific question. How do I know I have a complete and accurate data set? And so what we have found, the challenge here is very, very difficult to reconcile your data because it's very immature and inconsistent reporting throughout the ecosystem. Some examples of that are the data that you come in is similar, but it's not the same. Some of the rows of the data don't match up. As we talked about, the tickers and pairs don't match up. The decimal places don't match up. And that creates some challenges to reconcile. Also, the data comes in out of order. And so, you know, the use case that we see all the time is a taxpayer is pulling in from 20 different sources, and one of those sources goes down for a day. And so at the end of the day, they create a P&L, and they're creating a P&L based on data from 19 different data sources. Well, the next day, the data shows up. And now all of a sudden, they have to go back and they have to change their P&L. Well, that creates, you know, for the controllers out there, they would know, that creates some significant reconciliation issues. And then I think the final, which, you know, most of us in the ecosystem would understand, is most of the data that you get is inaccurate, it's inconsistent, it's duplicated. And so you need to have an automated way of collecting and standardizing all of that data before you reconcile it. And so the one thing that we would stress to taxpayers is just because you collect your data, just because you standardize your data, you have to make sure that you go through a process of reconciling that data to ensure you have accuracy and consistency. Otherwise, all of your downstream calculations are going to be incorrect. Okay, so now we get to processing. So luckily for some, you know, using the right tools, hopefully Lukka tools, you've been able to get to this point. And now you have to process your transactional data so that you can then pass it to Sovos. And here's where you get into some additional complexities, because some of the processing that's requires a little bit of a leap of faith because guidance is limited, and there's various opinions on how you account and report for crypto. So some examples that we would see are, for example, crypto fees on crypto-to-crypto transactions. Do you treat that fee as a disposal event, or do you take that fee and do you add it to the purchase price to create your cost basis? We would think it is the first, not the second, but there are differing opinions. Additional issues are around what kind of accounting method should you be using, FIFO, LIFO, HIFO. You know, there's all different conversations there for different circumstances. Finally, if you have crypto, how do you put a fiat price on it? What price should you use? Should you use a VWAP, a volume weighted average price? Should you try to create a principal exchange? What is the definition of a principal exchange in crypto? There are none. Further, what is a closing date or time in crypto? Crypto is 24/7, 365. And so how do you know when you should actually close your books and put your prices on? So the point here is that when it comes to processing your data, what you're going to find is that the ground is a little shaky under your feet. And what that means is you're going to have to make a best effort. And our advice to you is be very, very consistent, be very, very transparent, document what you have agree to the extent that you have conversations with counsel or with your accounting firms try to get some sort of documentation from them as well. Do everything you can to make sure that if the IRS was to walk in and they would ask, why did you change from LIFO to FIFO, that you have a good business reason for doing so, and it's not going to be viewed as just a way for you to get preferential treatment in terms of paying reduced taxes. All right, so just quickly to summarize some of the best practices again, you know, what you got to do here is you're going to have to programmatically find ways to extract your data. If you are trying to extract transactional data through CSV files, you're going to at some point in time miss something and have an inconsistent data set. Number two here would be to make sure that you apply standardized reference data. What you're going to find very quickly is when you're pulling in this data, it is not consistent in any way, shape, or form, and you have to find a way to programmatically fix it. Doing it by hand just is too onerous and expensive. Once you have all that data in place, make sure that you have a very robust process to reconcile, and that all of the prior data collection and standardization processes have been put in place. And then finally, as we talked about, be very, very consistent and transparent with the approaches that you're using for reporting, because, you know, as we know, guidance is not solid yet. We're waiting for the IRS here shortly to come out with some, certainly, but in the meantime, you know, make sure you just document. All right. So we're going to revisit the prior slide because I do want to just take a moment just to kind of lay out the solution offering that Lukka has here in terms of solving for some of these problems. So as we talked about, data connectivity is key. We're pulling from the left-hand side of the slide data from many different sources. And so one of the things that Lukka has built is connectivity as a service infrastructure to support the automation of that process. Lukka blockchain nodes, this is a set of nodes that allows you to verify and reconcile that you have complete and accurate data. Reference data, again, we have a product offering that allows the standardization of that. Lukka pricing that allows you to put a price, a fiat price on your crypto, and then obviously reconciliation tools. All of that information then goes into the Lukka Crypto Office platform, which you could think of here as a subledger, which holds all your data. And that all of this infrastructure has been tested. We have a SOC 1 Type 2, and then we take all of that information and we produce all of the reporting outputs that we then in turn hand over to Sovos so that they can create all of the forms required. So with that, I'll hand it back over to Wendy.
Thanks. So yeah, I mean, just to kind of recap where we are in this process, right? In this part, we've received the tax reportable data from the crypto exchange clients from their sources, and then we've received the cost basis and the calculation data from Lukka for the recipients, and it's time to aggregate it and transform it and format it into the required 1099B outputs for reporting to the recipient, to the IRS, and then on to the states. So when taxable transactions occur, specific tax information is required to be secured from the recipient. Sorry, was there one before that? Oh, okay. Just missed one there. Sorry about that. Okay. So this challenge, I would highlight this with tax information reporting, is a significant burden on internal resources. So next one, sorry, yeah, thanks. So the requirements are changing constantly. I mentioned earlier, especially if the payer is required to report more than a single type of tax form to the IRS in the states. When compliance rules have to be tracked and interpreted, operational resources have to coordinate those changes with customers and internal teams, and then project and technical resources have to go back and update the operating systems. So on the right side of this slide is just a kind of an interpretation of what we call the year-round activities involved in tax information reporting. So this isn't just a once-a-year process despite what you've heard. This is a significant investment for an organization, particularly as it grows. So we really recommend that you outsource activities that are not your core expertise, right? Particularly activities that come with hefty penalties. Failure to comply with IRS 1099 reporting requirements has significant monetary repercussions for an organization. And the data that you file with the IRS is the first clue to them that you might have a compliance issue within your organization. So we always say, you know, invest in compliance experts and be prepared for an audit. So the second challenge that I would highlight here is that, you know, when taxable transactions occur, specific tax information is required to be secured from the recipient. And when that information conflicts with the IRS or with the Social Security Administration, then the IRS will produce a penalty to the payer, along with a mandate for them to withhold taxes on future payments. And this can include a whole other set of operational issues that I'm not going to get into today. But the most common issue is that a payer will submit an erroneous name TIN combination on a Form 1099 to the IRS. So think about things like naming conventions, right? The estate of, the so-and-so family trust, nicknames that individuals use, married people who don't update their names with Social Security, and then people who just plain give you the wrong information, whether it's their wrong social or tax ID number or the way they've written their name. So the penalty that gets produced to the payer, it can be waived, you can have it abated, but you have to go through another process to demonstrate some specific actions that are outlined in the Internal Revenue Code in order for you to qualify for that abatement. And again, this process imposes additional operational and legal activities that I'm not going to get into today, but how can you prevent this, right? That's what we're after. And so we recommend here that you utilize the IRS's TIN matching solution to validate information before it's filed with the IRS. So this requires a review of the data before it needs to be submitted, and then some sort of remediation activity with your client in order to get the information updated. And you'll want to do this before you file those 1099 records. So we always recommend to our clients a periodic review using that system in some way. We have clients that are bringing data into our solution daily, and then on a monthly basis going out and doing the check. We have clients that bring it in daily and have integrated the matching solution that we have within their onboarding platform for new clients as they go forward. So again, we recommend using that system in some way, shape, or form to minimize or mitigate those penalties. All right. And then the next challenge here is this just significant volumes of data that have to be extracted and processed for 1099-B reporting. I mean, Jeremy did a great job of showing all of the different details that have to go into it. I kind of summarized it into dates and lot descriptions and amounts. That makes it sound so easy compared to what you did. But at the end of the day, this form requires the filer to produce a 1099 for every single transaction that a single recipient undertakes. So there's no aggregating of transactions for purposes of reporting on this form. And unique characteristics about the trade, like the names, the address, the TINs, the dates, all of that Jeremy showed before, all of those things have to then be transformed into the IRS format to land somewhere on that 1099-B form on the right side of this slide. And also that information needs to be validated to make sure that it makes sense for each box that's calculated on the form. So for example, the IRS has rules that say things like if box 1 has such and such value, then box 6 shouldn't be such and such. So there's these rules that occur within the form outside of the actual decision making that you had just to get to putting an amount on this form. And then we recommend that our clients invest in a tax solution that can grow with them, one that can scale to handle the large volumes of complex data, and especially in this new market where we see a lot of startup businesses and exchanges that are growing so rapidly, and so their 1099 form volumes tend to just drastically increase year over year. You're going to find if you're one of these payers and you begin to look into this process that there are a lot of providers in the market for smaller volumes of data, and they make it very easy for, let's say, under 2,000 forms. But when you get yourself into a situation where you want to grow into more than 2,000 clients and you want this to be a bigger business, then we're going to definitely recommend that you invest in technology that can scale with your business and handle that large complex data. Every 1099 form, as I said, it comes with a specific set of rules and for each box on the form, and this 1099B form is no different. When data is coming from so many different sources, clients often find themselves creating like manual tests of the data based on maybe what their knowledge of the rules is. We really recommend that this practice be automated, especially when there's higher volumes of data being processed. A centralized solution, or even just one that sets apart from the source, when it can ingest the tax information and then produce red flags before you file that data incorrectly with the IRS, is the ideal way to handle this. And so again, just to kind of summarize the best practices that we talked about on these last few slides, I mentioned utilize the IRS TIN matching solutions before you file any 1099 related data. Outsource your compliance, your operational and your IT activities to a third party. Honestly, it is amazing to me how many people start off with building their own solution or going with a solution that can't scale. And then as things grow, they just begin adding more and more people and cost. And next thing you know, it costs them more to maintain it internally than if they had just outsourced it in the first place. Invest in technology that can scale to handle those volumes. As I said, there's a lot of providers that very few of us out here that can handle the hundreds of millions and even the billions of transactions. And then invest in a modern tax solution that provides you with some validation, provides red flags of invalid data before you file that incorrect information with the IRS. So I think that concludes our session for today. We hope that you found this information to be useful. As you think about how to comply with these coming tax withholding and reporting requirements, please know that Lukka and Sovos have partnered to provide clients in the virtual currency space with a holistic tax information reporting solution. I guess we would turn it back over to you, Ryan.
Yeah, absolutely. So thank you both very much. We'll have some questions coming in from chat. For those of you who are on the call, everyone is muted. Obviously, this webinar is being recorded. Please submit your questions via chat. And Jeremy, I'd actually like to start it off with you if I could.
Sure.
Real quickly. You had mentioned disparate data sets. You had mentioned disparate data formats. One of the things that we've often spoken about is also given these various sources of data at exchanges and new exchanges that will come up, they also potentially have capacity and throughput problems. The ability to pull vast amounts of data, some of them can handle it, some of them can't. How is Lukka prepared to manage that, and what is your perspective on what that evolution of data management looks like?
So we would imagine that just overall, the maturing of the APIs from which we grab transactional data will follow sort of standard IT. So right now they're REST APIs. Eventually they're going to get into FIX and other methods that are stable and more scalable. So I think over time, just like anything, they've started with a base type of connectivity, and the more robust exchanges are investing to new technologies that allow us to get the information out. So I think that's number one. In terms of how you deal with it, really what happens is we have connectivity to 30, 40 exchanges, whatever it is now, and every single one of those exchanges, we identify what are the specific limitations, and then we create our strategy for pulling data based on those limitations. So for example, Bittrex only allows you to pull, your last 200 trades. So you have to set up a way to pull information from Bittrex such that you're never going to be, within that, outside of those 200, or you could miss transactions. You have other exchanges that only allow you to pull every 2 to 5 minutes. And so you set your staging of pulling that data based on whatever limitation that they give you. We call it speed bumping. So however they speed bump you, you set your limitations up. So I think it's just a matter of having the technical capability and understanding in terms of what those limitations are, consistently being able to keep up because those things change all the time, and then working with those exchanges. And we have a lot of conversations with exchanges about maturing their API infrastructure so that it gets to something, a much more stable type of technology, which we would envision to be fixed over time.
Great, thanks. So we do have some questions coming in. Again, for those of you who are on the call listening to this webinar, the recording and the slides will be made available. We'll certainly be sharing them with our friends at Sovos and Lukka as well. One of the comments that was raised, and I addressed this to you, Wendy, is quote, I think it's too broad to say that ICOs do not qualify as a tax-free capital raise. It depends on a variety of factors, including what the underlying token represents. How do you respond to that? Because we hear that question a lot as well within the organization.
So I think that the IRS has very specific language around that exemption that we're talking about, and it most certainly does not address ICOs, but that's a problem on the IRS. I don't think that's anything that is necessarily done purposely or that they're going to continue to exclude it. I just think that the way that the regs are written currently is the problem. So that kind of goes to some of the outside of the tax reporting side of it. That goes more to the is it excluded down the road or is it income, which I think goes more to some of the accounting conversations. When do you have to realize that as income? So
right. Thank you, Wendy. Appreciate it. Another comment: most ETH airdrops have negligible value on date of receipt. But for large ETH holders, Ethereum or Ether rather, this is a material issue. How do you respond to that? What's your framework around commenting?
The problem we have right now is valuation. That's a big problem in the industry, right? Because even those who want to do it correctly or want to try to do cost basis, it's difficult to know whether or not you're relying on a good source for valuation. And I would say that is supposed to be coming in the guidance. That is, certainly I've always said, for example, I used to do lead mortgage operations, and we get into this conversation about property sales, how do you get the fair market value of your house? And we would say, there's a variety of sources out there on the internet where you can get that value, as long as you're using a consistent method and one that is somewhat reliable within the industry. And I think that's a good approach. I don't know if you would add to that.
Well, I guess, the other thing about airdrops, which is interesting. So you could talk about it, you could talk about it from a valuation and a technical standpoint. And then you have the computer science side of airdrops, which is how the heck do customers even know that they got them? One of the big issues with airdrops that we see is a lot of our customers don't even know that they got the airdrop, and they don't know where the airdrop is, because most of the data that comes through the APIs don't necessarily flag saying that, hey, you just got this airdrop, you're a little bit richer today. And that doesn't happen. And so it's not only just on the valuation side, it's like just being able to find your airdrop in many cases is a challenge for taxpayers.
Wow. Interesting.
I'm going to skip ahead on one of the more in-depth questions because I think it's relevant though. Quote, I've never seen any reason to use LIFO other than reducing cap gains. Now, in a world of crypto, that has a unique perspective now. What are your thoughts on that?
I would ask you. What are your thoughts?
We don't offer any tax advice. I guess just broadly speaking, what I would say is, just interesting if I think across our customer base, we did have a bunch of people that used LIFO. I would say 12 to 24 months ago. And then they must have brought in some professionals, because almost to a T, every single one of those folks has flipped over to FIFO. So I'm not a CPA, and I'm not in a position to offer tax advice. I would just tell you what the data tells me is whoever provided that comment is right on point. FIFO seems to be what most taxpayers are using today.
And we see that in the traditional broker-dealer space for cost basis.
Right.
So, yeah.
So Jeremy and Wendy also, some of us coming out of financial services and financial markets, we're very used to things like consolidated tape for identifiers of particular securities across multiple market spaces. You can envisage a world where there are multiple crypto assets, cryptocurrencies, and this challenge of data reconciliation and identification reconciliation and matching becomes almost out of hand. Do you foresee a future where, in some way, shape, or form, regulators mandate a type of consolidated taxonomy, for example? And would that be useful, or is it just too early to have that conversation? One of the institutional challenges we hear is, I don't know what Stellar is and what it looks like, by way of example, on any particular exchange. How do I quote it?
Well, I'm a free market guy, and my comment would be, I would hope that we as market participants could come up with offerings that would allow for this problem to be solved, rather than something that is prescribed and mandated by a regulator. However, with that being said, it is a very big problem. When people use the term distributed and decentralized, those words have big meaning. It means that people at the endpoints can call things anything they want, and no one can tell them that they can't. And if in fact they decide to call Bitcoin, they decide to create a new ticker for Bitcoin, TBX. If enough people want to trade on that venue, they're going to have to adopt TBX as a ticker symbol. And I don't know how regulators are going to be able to regulate away that sort of issue. But this is a very big problem. We created a product called Libra Reference Data, not because we had in mind that we were going to create a product to do this, but because we had this business problem of we were pulling in all of this data from all of these different sources and nothing looked and smelled the same. And unless we put in place some automated tools, we couldn't figure it out. But I guess I would summarize it by saying, I hope the market can come up with some solutions. There are a variety of different players that are attacking it from different venues. You have Lukka doing what we're doing. You have Masari doing what it's doing. You have TrueSet doing what it's doing. So there are players that are playing with this in different ways. And I think we should be able to figure something out. I guess as a sidebar, what was interesting is the SEC back, probably at the beginning of the year, put out a call to the industry asking for information related to reference data. They knew that this was a big problem. And I suspect that when they step into this with whatever they're going to do, that's going to have a substantial impact in terms of the way the market is going to react.
And I would add to that and say that that's something I've been saying for a while, is that we really need the SEC to do that, because the IRS needs that framework in order to write the requirements for reporting and for income tax. So right. I think that what we're going to see from an IRS perspective is similar to what we've seen from the SEC, which is, a little bit of substantive guidance, but it's not going to answer every question and it's not going to tackle every problem that we're seeing. Right. Only other thing I would mention is that when you talk about cost basis reporting on a 1099-B, this is something that in the traditional broker-dealer space, actually back before about 2010, you would report what we see today happening out of exchanges, which is a gross proceeds amount, because cost basis is not a simple thing to implement, not only with the payer who's doing that, but just the general, all these things we're talking about is how do you value it and where do you get the ticker, where do you rely on that and what should it look like on these forms? And so when the IRS first came out with the regs in 2008, there was a very long implementation period of waves of the regulation. I anticipate that we will see something similar here, that they will give us some guidance through rulings and procedures that will give us some idea on how to maybe start with gross proceeds, but then we'll move forward into cost basis. When they did this back in 2008, they started off with different asset classes and they would just roll it in one asset class at a time. So figure out what they want to do for, bonds, figure out what they want to do for mutual funds and so forth. And so I think we'll probably see something similar.
Yeah. I think for gross proceeds versus, standard cost basis, I think that's the only way to go, because obviously cost basis doesn't travel across exchanges. So yep. If you move, a coin from your Coinbase wallet to your Paxos wallet, and from Paxos wallet to your Kraken wallet, it's very challenging without, a tool set like Lukka or others to be able to have that cost basis travel with you. Right. And so that's why, many times the customers that come to us, they're calculating their cost basis on a per exchange basis, because they're not able to see it in a consolidated view.
And we still see that even in broker-dealer space. And we were just talking yesterday about like a bond, that you could have inherited from somebody that purchased it back in 1950 before we ever had to do any of this cost basis stuff. Right. So, you still have some onus goes on the taxpayer, unfortunately, in those situations. Right.
One last question that came in, and I think it's more related. And Wendy, I want to start with you if we could real quickly, and I think we only have a couple of minutes. As a non-accountant, it was an interesting perspective. We've had a lot of inbound questions about the impending IRS guidance, allegedly. And one of the things that kept being brought up was hard forks. And I think you might have addressed it in the prior slide. But why is that such a concern? It almost seems to be more of a concern than we anticipated. Is there this anticipation that there will be more hard forks over time? And what are the implications of that from a taxation and reporting perspective?
Yeah, I think there's definitely that anticipation that there will be more over time. But I also think that there are some hard fork versus a soft fork. I think sometimes there's discussion about whether those are actually taxable at the time. That's really the discussion. And I think that is what we're going to see the IRS come out with. That's maybe what they were alluding to. And they said some of those transactions people thought were not reportable, maybe are, or that were exempt, maybe are not. And so I think that's what we'll see. I would say say that we're going to see a lot of them, and I feel like that's mostly because of the maturity of the industry, but I don't know if you would agree with me.
Yeah, I don't have a view here. I just know that this is something they're going to have to figure out. I mean, Ethereum is, you know, sort of the poster child for some of these, you know, so I suspect just to support all of the taxpayers that hold ETH and all of the subsequent forks from it, they're going to have to come out with something. But we don't have any specific view or insight on that type of question.
Great. Thank you, Wendy. Thank you, Jeremy. Thank you to all of our friends at Sovos and Lukka. For all of you who dialed in, thank you for joining us today. We will make the recording available to you, and join us next time.